Good evening and a very warm welcome to First Issues. The New York Times once wrote about a 57-year-old laid-off New Jersey supermarket executive without health insurance who received a $171,569.44 bill for his 6-night hospital stay after suffering a heart attack. That is the equivalent of almost 1.6 million pula. But it is not only your health that can take an unexpected turn for the worse. Houses and businesses burn down, expensive possessions break, and there are car accidents all the time. Life happens, as they say, to all of us at any point in time. What do you do when you suffer an incident that is said to cost you thousands or even hundreds of thousands of pula? In these economic times, regardless of how much you make or how impressive your savings, there are situations beyond your capabilities that can never be completely secured. We have previously presented on various topics to empower the First Issues viewer with the skills and resources to build a sound financial plan. But our exploration of this topic cannot be complete without factoring in the important topic that is insurance. Especially when most of us are making financial resolutions to have a more prosperous new year. In the perilous scenarios described at the very opening of tonight's program, insurance is the only means to protecting your finance. There are, however, many forms of insurance, and unfortunately, no one-size-fits-all solution. But after the break, a panel of extremely qualified experts will begin the journey of equipping us with the tools to navigate what appears to be an endless array of products on offer, helping us to effectively protect our livelihoods and homes. Welcome back to First Issues, as we look to get a firm grasp of a topic that affects us all, regardless of age or income bracket: insurance. Our panel tonight consists of returning guests, personal financial advisor Edna Dambe, Ziki Nganunu, former CEO of Botswana Insurance, as well as Lulu Rasebotse, CEO of Liberty Life. Edna begins by giving us both a technical and layman's definition of what exactly insurance is.
When you look at the meaning of insurance, you've got the basic technical meaning, which is a risk transfer mechanism, right? Basically, the risks that I'm likely to face, I wish to transfer them onto the insurer, who will pool these risks. Basically have many people like me pay for this coverage to ensure that in the event that one of us is affected, we will, they will be able to pay me out, but we cannot all get affected at the same time. So it makes the cost more affordable. But in layman's terms, what we're basically talking about is a system where the insured, this is the person who buys insurance, is put back in the position they were in before tragedy struck. That is how I would like the consumer to view insurance.
What are the main things a consumer should take into account when looking for an insurance solution?
Well, you see, the thing is, consumers need to understand their needs first, because we tend to buy insurance because it is sold to us. And we need to understand that insurance is something that is meant to satisfy my personal need. So I should therefore look at my need, look at my personal situation, and then look at the products available out there, and then match my need with that product. If you go back to the whole system of insurance, you need to understand that, insurance will provides cover not only for people, but for businesses as well. With people, we call that the personal lines, and the business insurance, we're looking at commercial lines, right? Now, businesses differ. Some are small, some are large, some are higher risk than others. So yes, the same applies to both the person and the business.
What are the best ways in which a consumer can educate themselves on what is out there and what they need, what suits their needs?
Typically in markets like these, we leave this to the intermediaries, which should be your agents or your brokers. That is the role of a broker and an agent, to educate clients. But equally so, the onus is on you as a consumer. Remember, because you're going to be paying for this eventual benefit, you should understand what it is you're buying. Maybe as a way of an example, when you're sitting and you're assessing your immediate risks in life, and you want to buy a policy, for example, and it's a life cover policy, and you are who you are as Namiso, perhaps you're not married, you have no dependents, your parents are self-sustaining, and you go out and buy a life cover. A life cover is not what you need immediately, but maybe what you need immediately is funeral cover, because that's a reality. Funeral will happen whether you will die or your dependents or beneficiaries may die. You'll need to contribute. So really, like I said, the onus is upon us. There are products as well which are designed for things which, as an individual, are a likely occurrence in your life. Say, for example, you come from a family where there's an incidence of breast cancer, probably through each generation. Therefore, it's hereditary. And when you're sitting there, you're going to say, but my grandmother died of this, my mother died of this. What are the chances of me getting it? Immediately, you'll know that maybe you need to take critical illness as a cover because you run a high risk of getting breast cancer.
I would advise consumers to read as much as they can on the internet and just pick up various reading material here and there, because you find that all of these insurance companies actually print brochures with a fair amount of information in them. And, you know, the problem we have is that the only time I pick up this brochure is when I want to buy immediately. You know, go around to these service providers, pick up their material, read it. What you don't understand, go back to them. They will be more than happy to explain issues to you. Don't wait for the day of need. Do you understand? So I also feel insurance companies should offer sample copies of their policies, because in a lot of cases I will go and buy cover and actually find that I receive the policy document later, at a later date. Now, by then I've committed myself, and this is a problem. So I think they need to make available sample copies of policy documents so that I can, at least in my educating myself, pick up a policy and say, well, this might actually work for me.
Consumers must understand the role of the agent and the broker, the intermediaries. Most people think the job of the broker is simply to get them the cheapest quote. And whilst the broker can do that and does do that, the important thing is that the broker and the agent are supposed to give you advice, impartial advice. They're supposed to help you understand your needs, understand products available which are most suitable. And it's important that as a consumer you spend time with that intermediary to understand the products and for him to understand your needs before you ask for 3-4 quotes from that person.
When asked whether consumers can honestly trust someone selling them insurance to give them advice that is in their best interest over any commercial interests they may have, we were told to first learn to differentiate between brokers and agents. How well can we trust that an agent is genuinely looking to assist us rather than just making a commission?
One thing you need to understand about intermediaries, first of all, differentiate between the broker and the agent. It is what we call in insurance polarization. Do you understand? Now, the agent works for a particular insurer, and the broker represents the whole industry. So you should get more breadth of advice from the broker than you can expect from the agent, who is only representing those products which are presented by that particular insurer they're working for. Do you understand? Now, insofar as having the broker sell you, or the agent, or the intermediary sell you a product which is for their more for their benefit, basically that'll give them a higher commission than what is good for you, takes us back to the regulator. That is where the regulation has to be in place to ensure best advice. Do you understand? Because in the UK, for example, you've got a policy of best advice, which basically allows me, the rest of my life, to come back and prove that the policy I bought was not given under best advice, not for my benefit.
The issue of trust in your agent or your broker, as Edna has correctly said, it goes back to the regulator. And if anyone is not happy with the advice that they've got, they should not hesitate or be afraid to, first of all, go to the insurance company to say, look, something they're not happy, or if that doesn't work, to go to the regulator, which is the Non-Banking Financial Institutions Regulatory Authority, NBFIRA, or the Ombudsman, who typically will refer the complaint to NBFIRA. The agents are regulated, and the insurance companies do have an onus to train their agents and make sure that they give impartial and proper advice. And if that doesn't happen, every consumer has the right to go to the regulator and put their case forward.
Going back to Edna's earlier point, I understand that intermediaries earn via commissions, and it's always a certain percentage. It's not a flat amount. So obviously, the higher the premium, the higher the commission. So in this world, we're all driven by financial gain. That's why we all come to work in the morning. So you're going to find an intermediary selling a policy which is of a high premium, which does not necessarily mitigate against your risk. But they understand that that high premium is going to give them a high commission. But over and beyond that, despite how long the policy is going to be enforced for, you'll find that the commission is paid upfront. So now you're paying this huge commission and it's being paid upfront. Needless to say, down many months later, the consumer finds this is not the policy that they wanted. But now the agent has gone AWOL. If as well we could as industry look at changing our commission structures to as and when. So each time a client pays a monthly premium, that's when the intermediary earns their monthly commission. In doing that, you're going to find that the business becomes very sticky and the policies are able to run the term in which they were designed to be in place for.
In your experience, what are the most commonly made mistakes by consumers when it comes to getting insurance?
For me, one of the biggest things that I think we do as industry is to overcomplicate policies. And not bearing in mind that actually our society is not as sophisticated, especially when it comes to financial literacy. Now, when you look back, even currently, burial societies, what's the purpose of a burial society? It's really funeral cover. But who in Botswana does not understand that your mother, your grandmother, yourself belong to a burial society? Because it's very simple. You pay this much per month. If you die, the society pays out this amount. So if we could adopt simplistic ways of articulating the risks, and beyond that, making sure that the client understands when it is exactly that they can get a payout, it just makes life much, much easier. But so long as we bring in things which have got all sorts of bells and whistles and the wording is one which the man on the street is not going to understand, we're going to find that we're fighting a never-ending war. And that's where as well the mistrust comes in, because right from the word get-go, understand, the consumer does not know what it is they have bought. The consumer does not know when it is they can claim for this thing. So I think really keeping it simple is what is also required by the industry.
On the short-term side, one of the common problems we tend to see is that policies are not kept current, meaning that at renewal, a lot of policies do not renew. Yet you know that the consumer still has the car or the house that they were insuring in the first place. And sometimes it's because of something minor like a change of address, which they have not informed the insurance company about, and the renewal documents get returned by the post office. Sometimes it's a case of they did not pay the renewal premium, and maybe they delay a bit, and then there's a claim. And that's when we have a lot of problems. You find that a premium wasn't paid, and there's a claim 3-4 months down the line. So I think it's very important for consumers to realize that in the short-term insurance, your premium is always due up front. It's always due up front. And if they don't pay it, insurance companies can reject the claim, and they often do. I think it's very important. Consumers must realize there isn't really credit as far as short-term companies are concerned. Generally, that's not how it works.
A lot of people buy products they don't understand. I find that's where the biggest challenge or the most common problem comes in, because you often hear people say insurance companies have cheated us. And we have a very bad name because people just don't trust insurance, when they actually bought the wrong product. I'll give you an example. I was once in a town in Botswana where I found a lot of people had bought a certain type of policy which was clearly not required. You know, I will mention the town. It is Orapa. Orapa is, first of all, entering Orapa, you practically need a passport. Everybody there had very high levels of burglary insurance. And we were trying to understand, how does this happen? Because, you know, they probably needed, you know, a different policy more, another policy more than they needed that one. Because the crime levels in Orapa are not the ones you find in Gaborone. You see, so people buy products because a cousin of mine has been given a job in an insurance company and I want to make sure that they get their commission or something completely. Understand that insurance is not a pair of shoes. You know, it's not, insurance is something which is so specific to your needs. You know, we turn around and say, especially where we're looking at investment growth, this is where people will say, well, I was paying 50 pula a month, and this agent promised that I was going to get 1 million pula in 3 years. And I still go ahead and pay the 50 pula, but can't I do my own math and see that the returns promised have no relation to the, you know, to the contribution I've been making? So let us at least understand what it is we're buying. We run into difficulties. The mistakes we run into are simply because, you know, as Lulu said earlier, we do not understand what it is we're buying.
Who is to blame then?
I take it back to the regulator, most definitely, because what the regulator needs to appreciate is that, you know, the industry is not a mature buyer. In this case, do you understand? They don't have enough knowledge of what it is they're buying. So, one, the regulator needs to ensure that the people who are allowed to sell have got the requisite knowledge to sell these products. And also, the regulator needs to ensure that there is enough time for me to assess what I have bought and still be in a position to return. Are you with me? You know, but there must be proof that I was given the right advice, and indeed I was missold a product. There is a lot of deliberate misselling. There are a lot of good brokers out there who are selling excellent products. Do you understand? But if you find a situation where a 75-year-old woman is sold a 30-year life policy. What does that mean? This is where the regulator needs to, have punitive action taken against that intermediary and the insurer that accepted that risk.
I don't think it's any single person's fault. I think when it comes to insurance, it's about joint responsibility. Being the consumer, the provider, the regulator, the intermediary. It's difficult to point a finger to any particular person. And really because, insurance as it is, you're selling a promise. And you have to wait for that incident to arise for you to realize that promise and say, oh, this promise has actually come true. And like Edna saying, it's not like a pair of shoes. A pair of shoes, you try them out, you try them on, you walk out of that tight, you move right back in and say, I don't want these shoes anymore. But really with insurance, it's that lag between you getting that promise being sold to you and you actually realizing the promise, by which time it may be too late.
We trust you enjoyed tonight's conversation as much as we have. Over the next few weeks, members of our panel will share more on short-term and long-term insurance, respectively. Until then, we leave you with some very wise words from Edna Dambe that truly sum up tonight's topic.
People need to understand that, yes, insurance covers risks. Not all risks are insurable. Do you understand? I can insure the risk of losing my expensive suit to theft, but not to wear and tear. Do you understand? So when I sit down and think of that which I need to insure, I need to also understand my ability to pay the premium. Do you understand? Because every policy has the premium you must pay. Every policy has the exclusion that Ziggy spoke about. Not the exclusion, the excess that Ziggy spoke about. One area which I find people do not understand is the exclusions in policies. Both short and long term. You find a person will take out a funeral cover for a third party and not appreciate that in the event of this third party committing suicide within a given period, that person is not covered because they were stated as a member. Are you with me? As opposed to a dependent. So we need to understand what is covered and what is not covered. But most importantly, even in insurance, understand that you are going to have to prioritize. So look at your needs, look at your budget, and understand which risks are likely to set you back most in your financial situation. And these are the ones that you need to at least put as your most priority.